Good evening. Ira Epstein with your Thursday evening financial market wrap-up, and this is for Thursday, as I just said, and this is the 26th of March, 2020. We're after 5:30 p.m., so we're actually in the Friday trade, and these are where the markets are as I'm talking to you. Now, it's been a wild couple of days. You know that I was not missing an action. If you're a subscriber to my research, not on YouTube, a subscriber, you've been getting my research. I've been putting out my morning subscriber videos and doing my best on my ETF spider videos as well. We had to rebuild the studio. We did. Little glitches, but they get taken care of, and they'll be all fixed up by next week at the latest, but I'm back. So where are we? Well, what you know is that there's a relief package. I think it'd be terribly wrong if you call this a stimulus. This is a relief package meant to save the U.S. The Fed has come to the rescue. We see the government's coming now to the rescue. There'll be more, not less. This gets you through a hump of 3 to 4 months, ideally. Companies that we can keep in business, we keep in business, and from there, the market has to move on into the stimulus part, which is down the road. So let's take a look at what the markets have done. You know it's been a vertical price decline. You've gone from a closing price of $33.81 to $24.37. You've had a little bit of a bounce. It might feel to you like this market, and I hear people say it, oh, this market's back, it's over the correction. Does that look to you like this is over? Let's take a look at a bar chart of the June S&P. I left up this cursor by accident, but I'm going to leave it as I finish. Here's your trade top. There's your trade bottom. All that you've had is a 1/3 price correction into that. Maybe you go to the 50% area. I doubt it, but it could happen. My point is, it's a bounce, not a change in a bigger picture. Be careful if you're thinking different. Now, on the daily charts, you ended a down leg. And why I say that is if I can get this to, there we go, come back. You had been making a pattern of lower highs on the swing line study, lower lows. The swing line I wrote, the study. And what it allows me to do is see is the market trending. You'll so often hear on financial TV, do we have higher highs, higher lows, lower highs, lower lows, or what are you doing? Well, this was a pattern of lower highs accompanied by lower lows. To take that out, you had to get right over that 2,500 level, which happened here on the 25th of March. And I'm sorry I wasn't with you, but couldn't do it. I'm back on the 26th, though. And here you are with a market that continued up. It ended a down leg. That does not mean it's starting an up leg. This is how you end a down leg, and that's what I think has occurred. Where is it occurring? How often do you hear me talk to you about the 18-day average of closes? That is a number you pay attention to, because what often happens is markets like to go to key moving averages, and I think the 18-day is a key moving average, and hang there. That, when you get under it, is a number it goes to. When you're over it, it's a number you pull back to. It often occurs. Moving averages are one of the, if you will, the most popular trading tools that algorithms and traders of charting techniques and so on use. This is something people look at. At the same time, we have a very bearish setup, and you've got to keep your eye on the 100-day average in green. It is a lumbering average, and it's looking at the 200-day. Is it going to get a bearish crossover down the road? I don't know. Right now, we have the shorter term average, the 18 under the 200 and the 100, and a number that's going to come crashing down is this black dashed line called a Bollinger Band. And in a Bollinger Band, the market looks at them as the support line. You can get under it, but you'll stay within it 95% of the time, or the resistance line on rallies above it. They're going to come in together right here. That's what it's looking like. Momentum-wise, we had a market that had locked-in downside momentum. That occurs when the two numbers that make up an oscillator of momentum called the slow stochastics, they're called a K and a D line, the red and the blue, stay under 20 for several days or more. A sign that the market has changed its nature. is when you lose it, when the red line gets over 20, if it's not gotten back right away the next trade day. Be careful. The odds favor that the market innately is changed, and it's going to try to make a run to the closest moving average. In this case, the 18 happens to be it. That's what I think occurs, and the market stalls itself there more times than not. And that's exactly what I think is occurring right now. In the NASDAQ, it's the same thing, but we had not embedded. We really got down in this market to oversold territory and then started a correction. We made a lower low, then we started coming back up. This was the 24th. Here's yesterday, and I'd look for that 18-day average to be the resistance point, and that seems to be where you're at today's action and tonight's early action. Now, the difference here is you're trying an uptrend. The market does have a pattern of higher lows and higher highs. Momentum's up, and the battle's going to be if it can stay over 77.21, then maybe it can make a run towards the 200-day average. What would reverse all this is taking out 73.10 and a quarter. Then I'm looking for the market to reverse course. In the Dow, if we take a look, you had that embedded reading. When you lose it, it is a sign that people are running for the hill. And the market doesn't have to change its big overall trend, but the short-term trend is ended. And I'm going to look for the closest moving average. And that's exactly what occurred. When we come over now and look at the Russell, we had an embedded reading. You lose the reading. And by the way, I teach all this in my charting course. You can do this on any chart. Take the name off the chart is what I recommend, and that's how I teach in the course. And then I bring back the chart names for you to see them, because it's all about understanding oscillators, patterns, and what's going on, and taking an educated guess at it. No matter how you rally, one of the things that bothers me is you're under that 18-day average. The bias, as I define bias, is down. So when this occurs, it's the end of a leg of a trend. It's not necessarily the beginning of something bigger, and that's what you're seeing. Will we hit that 18-day average? I don't know. I would expect that it's going to try to, but I don't think it's going to turn into a very bullish story. By the way, let's go back there. Let's assume it did. Where do you think the major resistance would be? Look at your 200-day. Your 100 in the green, your Bollinger Band. And what's going to happen in this Bollinger Band? This thing's going to come screaming down at the market. Think of that as your resistance point. It's going to be the first number that comes screaming down. In the VIX, the market was overbought, corrected, went back to the 18-day average of closes, and has been unable to do anything against it. So volatility, as measured by this, pulled back. This big run we had has come to an end. That does not mean you've started a downtrend. It's stuck right here at that 18-day average looking for the trend. If the market can get back under 52.17, because going home at 58.92 was the 18-day average. It closed today at 6,100. The bias is not down, so you need something to put it down to say you're going to get more of a rally. Where do you think I think the battleground in bonds are? This was that dramatic run-up that we had. Remember, we were looking at interest rates going absolutely bonkers. The word was, are they going to zero? And you pulled back, and now you ended that uptrend a while ago, and you've been either side of this 18-day average is normalcy. You heard what I'm saying. It's returning to a more normal state. Same in the 10-year note. You've got lower highs, but you have higher lows. See that? And you're trying to fight a battle right here against the 18-day average. No, there is no trend at work. In the dollar index, this is a heck of a move. Hard to have caught, but it was catchable for some that were willing to play this market. Here was the breakout. You had this low, you pulled back, and if you take out the high right here, that was it. But the first challenge of the Bollinger Band is where I normally teach. I think the pros are taking off money. And this market just soared to the upside. And suddenly, it's back into the point where it's not able to stay over that Bollinger Band. No surprise, only 5% of